Hey everyone, in this particular video we are going to discuss about the February 2026 RBI circular. So this is the part 1 of the circular video. So let's get the discussion started, guys. The very first news is related to RBI lifting the 2.5 crore investment for the FPI, foreign portfolio investor, under the voluntary retention route. Now this particular circular is loaded with too many technical terminologies, and one by one let's first understand the terminologies and then we'll be discussing the crux of this particular circular. So the very first thing is, if you are an FPI, foreign portfolio investor, basically you are a foreign investor. Let's suppose you live in USA and you want to invest in Indian markets as well. Right? So you have opted for a FPI route, foreign portfolio investor category. That means you are building a portfolio in India, right? You are investing in stocks, bond, mutual funds in India, right? And you are a foreign investor basically. So you are not like FDI, you are not doing a direct investment, because FDI usually involves seeking managerial control, but FPIs are just there to invest their money and they want to earn return on their money, and it's not like they need a managerial control like FDI, foreign direct investment, right? So now here we are going to talk about the FPI investment in the Indian debt market, right? So FPI investment in Indian debt market is very, very crucial. Why? Because central government, state government, corporate institutions in India who wants to invest their money in business, they need money, right? Everybody needs money. At the end of the day, everyone needs money. Everybody loves to raise capital, and that's how they also love to raise a good sum of money from FPI, right? So they are again raising their money via the FPI, and FPIs are also aggressively investing in the debt market of India, right? So earlier there used to be a limit for the VRR. Now what is VRR? Voluntary retention route. If you are an FPI, you are having three routes basically: the general route, the fully accessible route, and the last one is voluntary retention route. Now every route is having advantages and disadvantages of its own. Let's say if I talk about the general route, it is a standard FPI channel limit, and there are certain limits which you need to follow. So it's not like that the FPI can invest a n number of amount of money in the general route. No, it is subject to macro prudential limits. Okay, so there are certain limits in this particular category of general route, right? Fully accessible route, there is no limit in the fully accessible route. But can you invest in any security? No. Only in certain government securities you can invest, right? So if they have removed the limit in the fully accessible route, they have also, I will say, allowed the investment only in certain categories of the government securities, right? So in general route there are limits. In fully accessible routes there are no limits, but there are restriction in terms of the type of security you can invest in. The third one is voluntary retention route, VRR. Now what this voluntary retention route is all about? Now the government is saying that if you are investing money as an FPI, if you are investing your money as an FPI, you need to invest for long term. Because we need stable foreign capital. Why? Because we need stable foreign capital. So in VRR you will be subject to a lock-in. You will be subject to a lock-in period. Right? In VRR, you will be subject to a lock-in period. What is the lock-in period? Now this particular route, VRR, voluntary retention route, was introduced by Reserve Bank of India in March 2019. As the name says it all, you are voluntarily accepting for the retention. You are voluntarily accepting the lock-in period. You need to retain your money in the Indian market, right? For minimum period of 3 years. And because you are retaining your money for a minimum period of 3 years, definitely the government, the RBI, will be giving you so many other benefits as well, right? So let's start the discussion, guys. Earlier there used to be a limit of 2.5 lakh crore if you are investing in VRR. Let's suppose I am a FPI, foreign portfolio investor, right? I am investing my money in India. So there are three routes: general route, fully accessible route, VRR. I am choosing the VRR route. Is it like I can invest whatever amount I want? No. There is a limit. There used to be limit of 2.5 lakh rupees. 2.5 lakh crore. This used to be a limit in INR. Now this limit is removed. So is there the unlimited scope? The FPIs can invest their money in India via the VRR route without any limit. Is it like that? No. So what they did is they are just merging the limit of VRR with the general route. Okay, they are just merging the limit of VRR with the general route. So they have removed the 2.5 lakh crore wala limit from the VRR, and now the VRR investments will also be counted under the overall FPI debt investment limit. So there are some overall FPI debt investment limit which we are going to study right now. The very first update is, earlier we used to have 2.5 lakh crore wala limit in the VRR, which is now removed, right? So is there a situation like there is no limit in the VRR? No, it is subject to general limit. It is subject to general limit. Sir, but what about the lock-in period? The lock-in period will still be there. The benefits of VRR will still be there, but it is just the change in the limit. It is just the change in the limit, right? So what are the general limits in the FPI debt market? So here I am particularly talking about the debt market. If as an FPI I invest in central government securities, the capping is 6% of the outstanding stock. Whatever the outstanding stock is, the maximum amount I can buy is up to 6% of the outstanding stock. If I am investing in corporate bonds, I am an FPI, I am investing in corporate bonds, the capping is 15%. If it is the case of state development loans, that means loans to the state government, then it is capped at 2%, right? State government securities are capped at 2%, central government 6%, and corporate bonds 15%. This is the general limit. This is the general limit. Now the VRR limit is also merged in this general limit. So there is no separate limit of 2.5 lakh crore. Now this is a benefit definitely, because earlier there used to be a limit of 2.5 lakh crore and it was already 80% exhausted. It was already 80% exhausted. So now RBI has opened the VRR to the general route as well. So now the lock-in period will still be there. All the benefits of VRR, all the limitations of VRR will still be there in VRR, but your amount will be counted as a part of normal limits. Okay, so please do remember these limits, very, very important. And the news that RBI has removed the 2.5 lakh crore limit for the FPI. And because this is only for the debt market, you can see that all the securities are related here with the government securities like state government securities, state development loans and corporate bonds, right? All these are basically your bond market, or I will say debt market instruments, right? So this is the update if we talk about the voluntary retention route. Next one is lending to micro, small and medium enterprises. Now MSME is a very crucial part of India, right? MSME directly impacts the growth of India. Why? Because they are very, very crucial for the growth of a country like India, of a developing country like India, right? So this is just an amendment. This is not a full-fledged direction. This is just an amendment direction in the lending to micro, small and medium enterprise. If you are lending to MSME, then you need to follow this particular amendment, right? What is the amendment? Look, before moving to the amendment, would love to tell you the definition of the MSME, quite important for your examination, right? Because it was recently amended in March 2025. Okay, so it depends on what is the investment you have made in your plant and machinery, or what is your turnover, right? Investment in your plant and machinery is the first criteria. The second criteria is your turnover. What do you mean by turnover? Your sales, your revenue, right? That's nothing but your turnover. So you are a micro enterprises if you are having investment in plant and machinery not exceeding 2.5 crore. Your turnover is not exceeding 10 crore. Then definitely you are in the micro category. You are a small enterprise if your investment in plant and machinery does not exceed 25 crore, right? And your turnover does not exceed 100 crore. And similarly, you are a medium enterprise if your investment in plant and machinery is not exceeding 125 crore and your turnover is not exceeding 500 crore, right? So you qualify to be a micro, small and medium enterprise in accordance with this particular definition, right? So this definition is going to define whether you are a MSME or not. Now there are certain upgrades in this particular amendment direction. There was already a direction related to MSME and it is just an amendment, right? It is just a quick amendment. And the topic is all about collateral, right? So let's suppose if a regulated entity like a bank or a financial institution is giving money as loan to MSME, right? Definitely the MSME should provide a collateral as well. The MSME should provide a collateral as well. So this is all about the collateral requirements. So banks are mandated, if you are a banks are mandated not to accept collateral security in case of the loans up to 20 lakh extended to the units of MSE sector. So if you are giving a loan up to 20 lakh rupee, no collateral is required from the MSME, right? Banks are also advised to extend the collateral free limit up to 20 lakh rupee to all the units financed under the particular scheme, which is Prime Minister Employment Generation Program. So if you are giving money to MSMEs, right, if it is a part of program, Prime Minister Employment Generation Program, that's also fine, no collateral up to 20 lakh rupee. Or even if it is not a part of program, you are giving loans and advances to the MSE, then in that case, up to 20 lakh rupees, there is no collateral requirement. Very, very important for the examination. Okay, very, very important for the examination. Now, on their own discretion, the bank may itself, right, if the MSME is having a good track record and the financial position, then in that case, instead of 20 lakh, the bank can even give 25 lakh as collateral free loan facility, right? But it is based on the internal policy of the bank. So RBI has given a breathing space for the bank as well. If bank feels that MSME is quite capable in terms of financial position and as having a good track record, then the bank may also go up to 25 lakh rupee instead of 20 lakh rupees. Okay, so both the points please do remember very well for your examination, can be super important. Okay. And there was one more update related to the gold and silver, right? If the MSME is voluntarily providing gold and silver, as collateral, so I am a MSME, right? I am taking a loan from a regulated entity, let's suppose HDFC Bank, and I am voluntarily providing gold and silver as a collateral for this particular loan. So that is totally fine. It is never considered as a breach of any of the condition related to this particular circular, right? So that is the clarification. This clarification we have already covered 4-5 months back in the finance current affairs, right? So this is the quick update. So 20 lakh rupee most important limit. The second priority limit 25 lakh rupee is also important based on the internal policies and consideration of the bank, right? So this is definitely going to be super important for your examination. Please do remember these two limits and the clarification that accepting gold and silver is completely fine as a collateral, right? If the MSME is giving on a voluntary basis. And this circular and these amendments are going to be in place in the master direction from 1st of April 2026, right? So this was the quick update. Now let's guys discuss about the RBI amendment direction for the rural cooperative banks related to income recognition, asset classification and provisioning norms. So we are having a detailed chapter in your static part of the syllabus related to income recognition, asset classification and provisioning norms, and broadly we call these norms as prudential norms. And what do you mean by prudential? Prudential comes from the word prudence, right? Prudential comes from the word prudence. Prudence means foresightedness backed by intelligence, right? Now the accounting practices, accounting policies and principles are also based on the concept of prudence. So let's try to understand one by one how prudently a bank is recognizing the income, right? Before that, you guys need to know the concept of accrual basis of accounting. What is the concept? Accrual basis of accounting, right? In accounting, we follow accrual basis and we follow cash basis also, right? So let's try to discuss both the concepts. So let me just quickly take an example. Let's suppose I am a shopkeeper. I sold some goods. To Rahul. Right? The amount is 1 lakh rupees. The amount is 1 lakh rupee, but Rahul will pay me after 3 months. Rahul will be paying me the amount of 1 lakh rupees after 3 months. This is the requirement. So question number 1, when I have to recognize my sales? When I have to recognize my sales, right now or after 3 months? What do you think? Let me know in the comment section. When to recognize my sales, right now or after 3 months? मैं अपनी sales कब recognize करूँ? Whether I should record it right now or after 3 months? What do you think, guys? Any idea about this one? I should recognize the sales right now. Why? Because in accounting we follow accrual basis. We follow accrual basis. Sir, what is this accrual basis? Transactions are recorded in the period in which they takes place, not when settlement in money takes place. Let me repeat. Transactions are recorded in the period in which they take place. I am recording this transaction, say for example in the month of January, because I am selling the goods and services in the month of January itself, not when settlement in money takes place, right? So irrespective of the money settlement, I'll be always recording my transaction. That is called as accrual basis, and this is the fundamental accounting assumption. This is a very fundamental rule of accounting that we follow, accrual basis. Okay, so this is important. First you need to know this, and now let's discuss about this particular direction. Before that, I would like to tell you how a bank is actually recognizing the sales or the revenue. Now let's suppose I am HDFC Bank. Okay, let's take the example of HDFC Bank. How the bank is actually making money. So the bank has given loans and advances to the borrowers, right? Let's suppose 1 crore rupee at the rate 10%. So what the borrower will do? The borrower will be paying the interest as well as principal, right? Basically the installments, right? So every, I can say, year, the borrower will be paying 10 lakh rupees, 1 crore per 10%, 10 lakh rupees, right? So this is how a bank is earning money. So how the bank will be recording this particular transaction, whether on receipt basis, when the bank is actually receiving the amount of installment, that is the amount of principal or interest, or on time basis or on time proportionate basis, because this is loans and advances and it is having the time value of money, right? Why we are charging interest? Because you are using the money of the bank. So bank is charging money from you, right? So that's time value of money concept. So guys, this is nothing but accrual basis only. So transactions are recorded in the period in which they takes place, not when settlement in money takes place, right? So here also we will be following the accrual basis. It doesn't matter whether we received the money or not, but we will be following the accrual basis, at least for the standard advances. Now the question is, sir, what is this standard advances? Standard advances, we'll be understanding each and every stuff in a very basic, in a detailed manner, right, in a very simple language. So let's get this discussion started related to this particular circular. The name of the circular is RBI, Reserve Bank of India, Rural Cooperative Banks Income Recognition, Asset Classification and Provisioning Amendment Direction. So these are again amendment direction applicable to the rural cooperative banks. Earlier the rural cooperative banks used to follow some other system, but majority, I will say almost 99% of the regulated entities, banks, are following the accrual basis only, and in case of a non-performing asset, if the asset is not at all performing, we follow the cash basis. Okay, this particular direction is applicable only to the rural cooperative banks, because the rural cooperative banks used to follow some other requirement, and now RBI has streamlined the requirement for each and every regulated entity. So rural cooperative banks are regulated entities that provide banking services mainly to the rural and semi-urban population, right? So their target market is basically farmers, small traders, rural businesses and so on. Prudential norms are also applicable on the rural cooperative bank, and that's why RBI has amended the directions. Why? Because RBI wants to bring more and more uniformity in the income recognition practices and to align the practices of the rural cooperative banks with that of the other regulated entities. So let's start the discussion, guys. The whole idea is aligning the accounting, policies so that the treatment can be same, can be uniform in case of all the regulated entities, right? Let's first understand each and every terminology. So the first terminology is income recognition. What do you mean by income recognition? That means booking revenue. When the bank should recognize the income. So if you are paying me installment, right, in the form of interest or principal, when I should actually record it. So the bank is also following accrual basis, but only for the purpose of standard assets, right? So there are two bases of accounting: accrual basis, transactions or income is recognized when it is actually earned, or I can say transactions are recorded in the period in which they takes place, not when settlement in money takes place. I have made the sales, so I have earned the revenue, so I should record it right now. That is the accrual basis, irrespective of the fact that whether I am getting cash right now or in the near future. Cash basis only recognize revenue when you are actually receiving it, right? That is the concept of cash basis. Sir, what is standard advance? What is NPA? Let's try to understand this one. Now a bank has given a loans in advance, has given a loan to Mr. A. So this loans and advances, these loans and advances are asset for bank. Are asset for bank. Why? Because bank will be getting future economic benefit in the form of interest and principal repayments. So definitely the bank is going to earn money in the form of principal and interest repayments in the form of installment. So this is an asset for the bank, right? And this is a standard asset. When it will be a standard asset? When Mr. A is frequently paying interest and principal, installment of interest and principal, right? When the borrower is frequently paying the money to the bank, we say that the bank is generating income. The asset of the bank is actually generating income. But there is a problem when Mr. A is not able to pay the interest or principal for a certain period of time. For a certain period of time, if Mr. A is not able to pay the amount of interest and principal, then in that case, it will be treated as NPA. What is that certain amount of period? More than 90 days. So till 90 days I will wait. From 0 to 90 days the bank will wait, right? Let's suppose Mr. A should have paid installment of principal or interest here, right? But Mr. A was not able to pay it for n number of reasons, because of financial difficulties, because of losses, or because of any other reason. So I will say the bank will wait for 90 days. The bank will wait for 90 days, right? Till then it will be a standard advance. It will be a standard advance. The moment it is more than 90 days, it will be treated as a non-performing asset. The bank will start treating this advance as a non-performing asset. What is non-performing asset? As the name says it all, the asset is not able to perform well, and that's why the bank will change the income recognition criteria as well. In case of standard assets, the bank used to follow accrual basis. Whether we receive cash or not, the bank will be booking income. The bank will be recording the income. But in case of NPAs, we follow the cash basis only, right? We follow the cash basis only. Now this is as per the RBI prudential norms, and now these prudential norms as it is are going to be applicable. These concepts will as it is be applicable on the rural cooperative banks also, right? On the rural cooperative banks also. So this is the concept. In case of standard advance, we use accrual basis, but in case of NPAs, we use cash basis, right? If Mr. A is not able to pay you the money, it is now NPA after 90 days. Then why you will keep on recording the income? Don't you feel that your income will be overstated, right? You have over recorded. You have recorded that income in an excess manner, right? So let's wait till Mr. A actually pays the cash. So we will start following the cash basis in case of a NPA, right? In case of a NPA. This is the concept, guys. Now guys, let's discuss about the term provision, and then we'll be reading the amendment that is there in the circular. Almost all the amendments we have already done related to this circular, but still I will tell you from the circular like what are the key updates, right? So provision means setting aside money to cover potential losses. Say for example, I have given a risky loan of 10 lakh rupee to a borrower. Now I feel that approximately 10% of 10 lakh rupee can be a loss. Maybe I won't be able to recover the money of 10%, up to 10% from this 10 lakh. So 1 lakh rupee, what I will do is I will create a provision in advance. That is also being prudent, right? That is also, I will say, being prudent means you are anticipating all the losses and expenses which may happen in the near future. So let's start with the detailed discussion related to the amendments which are there in this particular circular. The very first thing, how you are going to recognize the income which is emanating from these standard advances. You will be recording them on the basis of accrual right? What is the meaning of accrual? Transactions are recorded in the period in which they takes place irrespective of the money settlement. If it is a standard asset, you will keep on recognizing it, no issues at all, right? Don't care about the money settlement in this particular case. Say for example, you have given 10 lakh rupees and you are earning 10% interest on it. You are a rural cooperative bank obviously. So 10 lakh pe 10% will be 1 lakh rupees. That's your annual interest. So on quarterly basis, let's suppose you are recognizing 20,000 rupees on every quarter. Now because this is a standard advance, you can follow accrual basis of accounting whether you have received it or not. Whether you have received it or not, right? However, if that is a non-standard advance, or I can say NPA, if it is an NPA more than 90 days, then definitely you won't be using the accrual basis, you will be using the cash basis only. You can record the income only when the borrower has actually paid you the money, right? So that is the case with the second provision. Now all these rules and regulations are already there for the rest of the categories, but this particular update is for your rural cooperative banks. Provision 3, reversal of income when loan becomes an NPA. Let's suppose here it was a standard advance, right? So you are booking the income in P&L on accrual basis, right? Now for above 90 days, the borrower is not able to pay the money, so now it is NPA. If you haven't received this income yet, what you need to do is you need to reverse this income now, right? So if the loans and advances are becoming NPAs, whatever income you have credited to your P&L account, whatever revenue you have booked in your P&L account, you need to now reverse it first, right? Because you haven't received it. So these are the summary pointers, guys. This is very straight. Accrual basis in case of standard asset, right? Cash basis in case of non-standard, and in case of non-standard, in case of NPA, you need to reverse the previous income if not realized in cash, right? Next one is related to non-banking financial company credit facilities. This is also an amendment direction. So they have just referred to a particular circular here, right, in a para, that now from now onwards the NBFCs have to follow the Reserve Bank of India non-banking financial companies income recognition, asset classification and provisioning direction, right? So it is merely an update in the reference, I will say. Next one is related to non-banking financial company income recognition, asset classification and provisioning amendment direction 2026. So again, this is an amendment direction. We'll be discussing about each and every stuff in this particular direction. So let's start the discussion. So this is regarding the default loss guarantee, DLG arrangement. Default loss guarantee is a very common terminology which we have studied earlier in multiple RBI circular. So first we'll be discussing about the meaning of this default loss guarantee and then we'll be understanding the circular. So this circular is all about default loss guarantee arrangement. Now this DLG is as good as a synthetic securitization only. Now sir, what is synthetic securitization? Before knowing the term synthetic securitization, you need to know the term securitization. Securitization is nothing but selling the loans and advances to investors, right? So securitization is the process of creating liquid securities out of a illiquid asset. Say for example, a bank is having loans and advance portfolio. The bank is not able to recover the money, so the bank is actually selling the portfolio, loan portfolio to someone else. That's what securitization is all about, right? So in securitization, the bank is actually transferring the loan portfolio. But in synthetic securitization, the bank is not actually transferring the portfolio, loan portfolio. Instead, the bank is just transferring the risk which is there in the securitization process, right? The default risk. Similarly, the default loss guarantee is also working in similar terms only. So first we'll be understanding default loss guarantee. So there were certain cases in which both the arrangements are completely prohibited. Synthetic securitization is also prohibited, right? But in certain cases, RBI has actually allowed the provision of default loss guarantee, right? And this is all about the provision of default loss guarantee only. So let me just give you the meaning of default loss guarantee first. Let me just explain you the meaning of DLG. It is nothing but a risk sharing arrangement. We are just sharing the risk with somebody else, where a third party guarantees a portion of loan losses, and usually the guarantor is a fintech partner or a lending service provider. Look, there is a borrower. We are a fintech company. So an NBFC or a regulated entity is giving loans and advances to the borrower because we have onboarded this borrower. Right? And we are sourcing the loans and advance from the NBFC. So I am a fintech company. What I do is I invite the borrowers to take loans and advances. Once I get the borrower, I will ask some NBFC or a regulated entity to fund the borrower, right? But because NBFC or regulated entity is funding a borrower which is emanating from my source, this is my source, right? I am bringing the borrower, I am onboarding the borrower. So NBFC will definitely be concerned about the thing that you, the fintech company, you have to provide me a guarantee. What if this borrower defaults? My money is involved, NBFC money is involved, right? What if this borrower defaults? So in that case, what the fintech company is going to do is, the fintech company is going to give a default loss guarantee to the NBFC RE, right? If this borrower defaults, fintech company is there to take care of it, right? So that is the idea of default loss guarantee. It is nothing but a risk sharing arrangement where the fintech company guarantees a portion of any kind of losses emanating from the borrower, right? So this is the whole idea. Now this structure resembles synthetic securitization. This structure is also resembling synthetic securitization. That means you have not given the loans and advances actually, but you have taken a risk. Right? That's what happens in the synthetic securitization as well. If you know the process of synthetic securitization, it is nothing but without transferring the loans and advances, you are just transferring the risk to someone else. Similarly, here the NBFC has not transferred the loans and advances to the fintech company, but NBFC has transferred the risk emanating from these loans and advances up to a certain percentage, which is called as default loss guarantee. Now RBI was quite concerned about this structure. Why? Because it resembles the synthetic securitization, and that's why RBI has amended these guidelines, right? So there are 3 paras which are introduced in this particular guidelines. Now RBI also uses expected credit loss model, right? In case if a lender is facing any losses, just like NBFC, what if the borrower is not able to pay the money, then definitely the NBFC will be facing the losses. So how the losses will be accounted for? By using the ECL approach, expected credit loss approach, right? So now this is also been adopted by RBI circular from Ind AS, Indian Accounting Standard 109, which is financial instruments, So this whole idea is all about financial instrument, right? We do have this concept in the financial instrument, and NBFC can now consider the DLG protection. So if NBFC has given loans and advances, in return the fintech company has given a default loss guarantee, then definitely NBFC can consider that DLG before calculating the expected credit loss model. How things can go south? If the borrower is not repaying the money, then definitely the NBFC can face losses, right? But DLG protection is there. What if the losses expect the DLG protection? Definitely it can exceed, right? So we do have a expected credit loss model, which is nothing but an expectation of what kind of losses the NBFCs or the regulated entity can have. So when you are following the expected credit loss model, no worries at all. You can also consider the DLG portion, because the DLG portion the fintech company is going to give you, compensate you, right? However, certain conditions will apply, and these are the conditions that you need to remember. The DLG must be integral to the contractual terms of the loan. When the NBFC has given loan to the borrower, there must be a contract, right? And the fintech company who has actually onboarded this borrower, who has actually onboarded this borrower to the NBFC, definitely there will be a contract, and the DLG, the default loss guarantee that the fintech company has issued to the NBFC, must be an integral part of the contractual term of this loan. So DLG should also be a clause in the loan, right? As the integral part of the loan, that means as the main part of the loan. Next one, DLG must not be recognized as a separate financial asset. We won't be recognizing the DLG as a separate financial asset. Instead, it is a part of loan only. And in the condition number 1 only, we have stated that it is going to be a most essential or the integral part of the contractual terms only. As NBFC, you need to comply with the Indian accounting standards requirement as well, because actually there is a compliance in the Indian accounting standards which relates to the disclosure requirements. So if Ind AS is applicable on the NBFC, then definitely the NBFC has to follow the Ind AS requirement as well. These are the 3 conditions which are stated here that you need to know. Expected credit loss model is nothing but a model where you can actually expect how many losses you are going to face on the credit or the loans and advances that you have given. It is also mentioned under Ind AS 109 financial instruments, and RBI has taken the reference of this particular model from the Ind AS 109 only. So RBI is nowadays also adopting more and more concepts from the Indian accounting standard, because someday the banks have to follow the Indian accounting standards. Right, there are three stages in the expected credit loss model. As of now, for the sake of this particular circular, you don't have to remember these 3 stages, right? Okay guys, so the very first thing is integral part. Second one is your not recognizing the financial asset separately, but it is an integral part only. And the third one is you need to comply with the requirement of the Indian accounting standards. So these are the 3 requirements that you need to take care of it, right? So that's the major crux of the circular, and only this much you have to remember for the examination perspective only. Next is guys the data released related to the BSR1 and BSR2. This is a quarterly data. Every quarter RBI is releasing this data related to deposits and related to the credit which were extended, and the credit that the banks have actually extended, and the deposits that the bank have sourced from different entities. Now the whole idea of publishing this data is to know the growth rate that we are having in terms of deposit, that we have in terms of credit. So let's get the discussion started. This is related to the December 2025. What data you have to read and remember for the exam, just before your examination ka quarter data you have to remember, right? So let's start the discussion guys. This is the latest data as of now. So we'll be moving ahead with this data. Now guys, the BSR1 data which is related to credit data, right? So what is BSR? Basic statistical return. Every regulated entity, say for example scheduled commercial banks, have to file their their return, right? A return which is based on credit, which is based on the deposit data. So the regulated entities like scheduled commercial bank, they have to file data with RBI. So one return is related to your BSR1 which relates to credit. The second one is BSR2 which relates to deposits, right? This is the main idea. And why they have to report it? So that RBI can also have an idea, like in terms of percentage growth rate, what is the position of credit, what is the position of deposits, and so on. So BSR1 is for credit, BSR2 is for deposits. Let me just quickly remind you, credit is an asset for bank. The loans and advances the bank is giving is an asset for the bank, and deposits are the liabilities for the bank. Let's quickly talk about the data. The whole idea of BSR system was introduced in December 1972. Okay, December 1972 BSR was introduced, right? And what is the frequency of BSR data? Earlier it used to be annually and now it is quarterly. As of now it is quarterly, and this data is related to December quarter, right? So guys, please do remember that BSR 1 and 2 data includes the data of scheduled commercial banks, but it excludes the data of regional rural bank, right? It excludes the data of regional rural bank. So quickly, let's jump on to the data points guys. The very first thing is the bank credit growth has improved marginally to 12.2%. This is the December 2025 ka data. Earlier in December 2024, it was 11.8% and as of now it is 12.2%, which is quite good as compared to the previous year, right? In terms of the credit growth rate, I can see that the green line agriculture is having the highest growth rate among the constituents, which is at 13.7%, followed by industry 12.9% and personal loan, which is represented by this red line, which is on a decline, is at 12.1%. The least one is personal loan, the highest one is agriculture loans, right? The total branches located in the rural areas and semi-urban areas in the urban centers recorded a higher credit growth rate than the metro branches. Now this is the important data, that the branches located in rural, semi-rural and urban areas were having a higher credit growth rate than the branches which are situated in the metro areas, right? The public sector banks recorded credit growth rate of 14.1%, exceeding the overall bank credit growth rate. So PSBs are now consistently outpacing the private sector banks. So in terms of BSR1 data, public sector banks are outpacing the private sector banks, right? So this is the crux of the data, right? This is how you have to remember. Now for the weighted average lending rate continued to ease. So the WALR, weighted average lending rate, this is nothing but the weighted average of all the rates that the banks are actually offering on the credit facility. So if I am giving you credit on 10%, so many other banks will be giving on 9%, 8% and so on. So this is the blended average, which is the weighted average lending rate on how much on an average banks are lending to the customers, right? So it has been now eased. So I can say it is on the decreasing trend, and definitely it is going to be. Why? Because the repo rate is also going down. The repo rate is also going down. So it is, I can say, in line with the trend of the repo rate, right? Ensuring monetary policy transmission is happening effectively. Then the easing policy of rate, the share of the loans bearing interest below 9%. How much of the loan is actually bearing the interest rate of below 9% is actually increasing, right? Earlier it used to be 42.2% and now it is 62.4%. So the loans and advances that are having the interest rate below 9% is increasing in terms of percentage share. So I can say definitely the interest rates are going downwards. Rest of the things we have already discussed in the chart format. Now let's jump to the BSR2 data, which is related to deposits, right? BSR1 is focused on credit, BSR2 is focused on deposits. Again, scheduled commercial banks included, regional rural banks are excluded. Now when I talk about deposits, there are so many types of deposits, like it can be current account, it can be saving account, it can be term deposit and so on, right? Now term deposits are basically your FDs and RD, which are having a fixed tenure attached to it, whereas current deposit and saving deposits are part of your demand deposits, right? FDs and RDs are type of your term deposits. Let's quickly talk about the data related to deposits. The deposits are actually growing by 10.5%. Earlier they used to go up by 11% and now they are going up at 10% as at December 2025. The highest constituent is the term deposits at 62.6%, right? So the among all the deposits, 62.6% is nothing but the term deposits. Obviously, why? Because whenever you want to save money for longer duration of tenure, then definitely you will go with the term deposit only, because it is giving you higher rate of interest as compared to the savings account. Then we have 28.8% of the deposits at saving account and then current account, right? Numbers are usually flat only. There's a slight increase in terms of term deposit, right? Slight decline in terms of current deposits. So that's the number, guys. Branches across all the population were doing good in terms of December 2025, and the public sector banks improved definitely at 9.9%, but the private sector banks definitely decelerated in terms of percentage, but it is still standing at 11.3% growth rate in terms of December 2025. So I can say that in terms of deposits, the private sector banks are outpacing the public sector banks, right? So that's the data, guys, that you have to remember here, which can be important from your examination perspective. To measure anything, we need indexes, just like stock market index. We do have Sensex, we do have Nifty. So when we say that the stock market is going up, we are talking about Sensex or Nifty, right? What is Nifty? It is a bunch of 50 stocks. It is an index which is having a bunch of 50 stocks. What is Sensex? It is having a bunch of 30 stocks in it. So whenever we say that the stock market is going up or going down, we are talking about the index, right? And not about the particular stocks. Similarly, if I talk about inflation, when I say that the inflation is going up, I mean that the CPI or the WPI is going up. So we do have index for everything. Just like that, we do have index for digital payments as well. Now, if I talk about digital payment, definitely it is about UPI, it is about RTGS, it is about NEFT, it is about IMPS, right? Mobile banking, each and everything is again a part of your digital payment. Whenever you are making a payment digitally, that will be a part of your digital payment index. And what digital payment index is all about? To check whether the digital payments in India, they are going up or they are going down. We do have an index for that. And RBI frequently releases the data related to the DPI. So this is the data which was recently released on September. This is related to the September 2025 month ka data, which was recently released in the February 2026. RBI DPI, this is called as a composite index. Why we call it as a composite index? Because there are so many things in it, like UPI, like RTGS, we have so many payment methods. And it is introduced by Reserve Bank of India. Why? Because RBI wants to measure and track the level of digitization in India. What is the level of digitization of the payments in India as of now? So this will be a direct indicator of that. So it is published since 1st of January 2021. Okay. So, but the base year, if I talk about the base year, from which year I am measuring the increase in the digital payments, I am measuring it from March 2018. Okay. So this is the base year. Please do remember the base year, it is March 2018 and base year is always equivalent to 100. Okay. Base year is always equivalent to 100. The launch date is January 2021. So since January 2021, we do have the DPI data and the base year for reference is March 2018. Now, why we have started the DPI from January 2021? Because after the COVID, there was an increase in the digital payments like anything, right? We all know about the UPI growth story as well. So that's why government also encouraged, the RBI also encouraged that let's start an index which is called as digital payment index, which will definitely tell us how much digitization is happening in the payment system. Okay. The whole idea is transitioning towards the dream of having a cashless economy, right? Purpose to capture the extent of adoption of digital payments, whether we are adopting the digital payments or not. It also helps the policymakers and financial institutions to analyze the progress and areas of improvement, right? So here we can see that in the Statement of Development and Regulatory Policies, which came in 2020, February 2020 ka statement, we can see about the digital payment index, right? So in this Statement on Development and Regulatory Policy, the statement was released related to the digital payment index as well. Let's start the digital payment index. It will be a great initiative. And here we can see recent data related to the DPI. This is for the September 2025 ka data. Earlier we used to have March 2025 ka data, and as of now we have the September 2025 ka data. So it is released on a semi-annual basis. So it is released for March and for September month. Okay. So half yearly ka data hota hai ye aapka. It will be published on Reserve Bank of India's website on a semi-annual basis. That means 2 times a year. So as of now, the data for September 2025 is 516.76. You have to remember this data. Okay. Please do remember the data. Earlier, the March ka data used to be 493.22, and as of now the data is 516.76. Okay, so there is an increase in the DPI is what we can conclude by having a look at the data, right? Now there are so many constituents of this particular index. There are so many parameters in this particular index. Okay, if I talk about this time, why the growth has been there from 493, why we are standing at 516 on September 2025, because of changes in 2 parameters, because of significant growth in the 2 parameters. The first one is payment performance. We'll be discussing about each and every parameter as well. The first one is payment performance, how well we have performed in terms of the payment, and the payment enablers. The payment enablers are the enablers of the payment. Okay, we'll be discussing about each and everything in this particular video. So there are two parameters. As of now, there is a growth in two parameters. There are so many parameters. Out of that, there was growth in payment performance and payment enablers. Because of that, there was an increase in the index value for September 2025. Let's talk about the historical trend of the index. So March 2018 becomes the base year, and after that, we can see a consistent increase. There was not a single release in which the data went down. We are having a consistent increase, and as of now in September 2025 we are at an all-time high DPI level of 516.76. So this is the first time we are crossing the 500 level. Earlier in March 2025 the data was 493.22, right? If I talk about the parameters and subparameters of DPI, this is going to be important for the examination. What things are important? The very first thing is the recent data, which is 516.76 of September, right? So data 516.76 plus the driving reasons. Driving reasons are payment performance and payment enablers. So driving reasons plus the data is very, very important. The very first thing, right? So these can be two questions. The third thing is when the DPI is released. So it is released on a semi-annual basis. Okay. So September 2025 ka data is released in February. So October, November, December, January, after 4 months approximately it is released. In 4 to 5 months it is released, right? So if I talk about March 2026 ka data, this financial year March 2026 ka data, it will be released by April, May, June, July. Somewhere in July to August month it will be released. Okay, somewhere in the August month it will be released. So if your examination is there after August, then definitely you have to study the March 2026 ka data. Otherwise September 2025 ka data will be relevant for you. Okay, but no worries at all. Even if there is a change in the data, we have to just learn the new data, but rest of the static concepts will remain the same only. So let's study now the static concept. Static concepts are basically the parameters and the subparameters. How the numbers are going up and down. Okay. So there are 1, 2, 3, 4 and 5 parameters in the digital payment index. The very first one is payment enablers. The things that are enabling us to make the digital payment. Internet. Without internet you can't make the payment. Mobile, you need to have a mobile. You need to have Aadhaar card, right? Your bank account and your Aadhaar card should be linked. Otherwise you won't be able to use UPI. You won't be able to use the other net banking services. Bank account, that's a very basic thing. If you don't have bank account, you can't use UPI. You can't use NEFT, RTGS and other payment methods. Participants, all of us are participants, including the banks, including the payment systems, other participants and merchants, right? Merchant is nothing but a seller, I will say. Let's suppose I am buying a t-shirt. So that person is a merchant who is selling me the t-shirt, right? So these are the payment enablers, because merchants do have adequate infrastructure first in their shop. So these are the payment enablers, I will say. These are enabling the payments. The second one is payment infrastructure. Second and third one is payment infrastructure, but payment infrastructure can be defined in both the ways. It can be demand side, it can be supply side as well. When we talk about demand side, it is more about debit cards, credit cards, how many debit cards are actually issued, how many credit cards are actually issued. It shows the demand, like whether people love to use debit cards or credit cards, right? Or maybe prepaid payment instruments, right? Fast tags, how many fast tags are issued. So these all are in the category of the payment infrastructure. Demand side infrastructure means how well we have developed the technology and whether we are able to fulfill the demand in terms of debit card, credit card. If you don't have debit card, if you don't have credit card, then the demand side infrastructure is lacking, I will say. People don't like to use the credit card. So I will say the demand side infrastructure related issue is there. Then we do have payment infrastructure supply side. How many bank branches are there? Higher the bank branches, better the supply chain is. Whether you are even able to serve the customer, whether you are even able to supply the products to the customer, products and services to the customer. So in the payment infrastructure supply side, we do have bank branches, business correspondents, how many number of ATMs do we have, how many POS terminals we do have. Then we are having the payment performance. In terms of performance, how well our payment system is doing. So how many unique users are there, digital payment system in terms of volume, what is the increase in the volume, what is the decrease in the volume, plus the value as well, right? So these are the payment performance related criteria. You have to read all the criteria, all the parameters as well as the sub parameters for the exam. Then comes the consumer centricity. How much awareness we are able to spread, how much education wise we are able to teach the consumer, explain the consumer about their benefit, right? What are the complaint redressal mechanism that we have stated, how many number of frauds are there, right? So all these things are in the consumer centricity, even the system downtime, which is impacting the consumers, right? So these are the 5 parameters, and each parameter is having certain weights as well, which we need to know. If I talk about the payment enabler, 25% of the weight is assigned to the payment enabler. What do you mean by weight? So if 100 is the DPI, digital payment index, if 100 is the DPI, then out of that 25% will be emanating from the payment enablers. Demand side payment infrastructure, only 10%. Then we have the supply side, 15%. Payment performance, 45%, the highest weightage in the DPI data. So this actually tracks how much usage in terms of volume, in terms of value we are doing, what is the success rate of the transaction, what is the speed and reliability of the transaction. The whole idea is what is the performance of the payment, and this is the most important thing. Why? Because we have so many credit cards, debit cards, doesn't matter, right? Consumer protection awareness is also a secondary matter, but when we talk about the performance, whether people are actually using the thing or not, that's what payment performance is. So actual usage of volume as well as the value wise usage is very, very crucial when we talk about the DPI data, and then consumer centricity is only having 5% of the weight. So if we evaluate in terms of weight, then consumer centricity 5%, which is the lowest weight. Then we are having demand side 10%. So demand side is 10% weight, supply side is 15% weight, payment performance wise is 45% weight, and payment enabler is 25% weight. Okay, so these weights also you have to remember. Okay, the highest one is payment performance, the lowest one is consumer centricity, and please do read the meaning and key indicators as well. I have simplified all the terms for you in this particular column. Okay, so thank you so much for watching this video, guys. I hope you have enjoyed it. It was full of learning for all of you in terms of what things are relevant for our examination and the recent update related to the digital payment index. See you soon in some other video. Take care.